Hello, this is Joe Pryor, the virtual real estate team in Oklahoma City, and we do investment properties in the Oklahoma City and the Tulsa market. What I want to talk to you about today is what's going on with kind of the combination of inventory and interest rates. Now, let's deal with interest rates first. So we have a Fed meeting coming up, the FOMC, where it's expected at least a 25 basis point decrease in rates. Now, the market in the last 2 weeks have already been reacting to economic data as well as things that Jerome Powell is saying about what's coming. So today we always get new rates on Monday. Sometimes we get updates if they change during the week, but actually rates improved this week. Now, a lot of that has to do with the fact that you do what's called an interest rate buy down to get the lowest rate. So if you do a par rate, and I want to explain this to investors, if you do a par rate, you're still going to be, let's say, 6.5%. All right, that means no points whatsoever that you're paying. But what mortgage companies do is they figure out a 10-year yield. They're looking at how much money they can make over 10 years. So if you're going to get a lower interest rate, they're going to charge you for it. So you do the par rate, and then it starts stepping down depending on how many points you want to pay. So right now, today, 5.375% on a 30-year fixed rate, 25% down, is the lowest rate for an investor. And that's fantastic because it was 6.625% less than a month ago. But you got to pay 3.5 points. Now, last week, it was 3.75 points for doing that. So let me tell you how this works. So normally, a new home builder is going to pay you some closing cost allowance. In other words, they're going to say, if you buy this house at this price, we're going to give you 2%, which is the maximum that an investor can get. Now, if you're an owner-occupant, you can get a lot more, but for an investor on a conventional loan, it's 2%. Now, let's take a $250,000 property, for instance, and that 2% would very simply be $5,000, right? Now, here's the interesting thing about points. Points are not based on the $250,000. They're based on your mortgage amount. So if you're at 25% down, that means you have a mortgage amount of $187,500. That's what you're borrowing. And that's what the points are based on. So we have the 5,000 here, and we have 6,200 or 65, let's say 6,500 and some change over here to get those 3.5 points, get the 5.375. So what it means is you take the 5,000 you're getting from the builder, then you're having to pay roughly a little over $1,500 out of your pocket to go from 6.5% down to 5.375% on 25% down. And by the way, on 30% down is 5.25 right now. And this could go lower in the next week or two. So that's the cool thing. Now, I've had a rule of thumb for almost 35 years now, which is, okay, if I'm going to put out this $1,550 or whatever it happens to be, I'd like to get that money back in 3 years. All right. So what I do is I divide that by 36 payments and I get $41 a month. That's what it's basically what that $1,500, I got to make $41 a month more. But if you compare it to a 6.5% interest rate, it's a huge difference. Plus you don't have to refinance. And that's going to cost you money every time that you do it. So here's my deal. We got a lot of great inventory right now. We have builders that will give you a 2% allowance, and you can have a locked-in rate for 30 years that you never have to fool with, and you can make a lot of money because cash flow is really, really good right now. That's my example of what an investor can do. This is why you buy down the points. In my opinion, it's the right thing to do. Be glad to have a conversation with you about this.